Hi, everybody, and thanks for joining us this afternoon for our second in-depth user group quarterly webinar. My name is Kathy Gregg. I'm a managing director here at Treasury Strategies, a division of Novantas. And I will be the first to admit that our goal to have these webinars quarterly, we're a little behind actually a quarter, but still we're trying to keep a cadence of that sort of almost quarterly. So thanks for joining this one. Here's our agenda for today. If you were on the last quarterly webinar, we introduced a similar format that we were going to try and use every time we got together. We were going to talk about the latest benchmarks, and each time we're going to discuss another in-depth concept. So there's a little bit of learning for this. Some of it may be basic for some of you, but for many of you, maybe not, maybe good education. So today we're going to talk about dashboard reports and how you might want to think about those. We also said each time we would address a cost savings idea, and today the cost savings idea is that of consolidating business as a possible way of saving money. And then finally, we're going to wrap up with a tour of our NDepth Pro product, which we've been talking about and alluding to for a while, but now that all the parts and pieces are together and finished, we want to take you through a quick little tour of that, and we'll wrap up with our little inner circle update, which is really information that you as users are likely to be most interested in. Let me say before we get into it, Q&A, always an option to type in questions at the bottom right-hand corner of your screen, and we'll try and answer them as we go along. We're working for CTP credits today. So when the webinar is done, I think I'm right about this, that we'll be sending you all a form that lets you apply for CTP credits if you choose to do that. And finally, for everybody who's registered, we'll be sending a copy of the deck and the recording once this is over with. Okay, so let's start out with the latest ECR benchmarks, which are getting more interesting. As you all know, we've had a couple of rate hikes. Well, more than a couple. We've had 3 rate hikes this year from the Fed, and we are definitely seeing those start to show up in bank earnings credit rates. What I have on this slide is the second quarter median rate curve for ECRs plotted against the third quarter. The third quarter is blue, the second quarter is red, fortunately. We see the rates are in fact rising, especially at the high end of the balance curve. But down there on the lower end of the balance curve, they've pretty much stayed flat. Up until $1 million, they really haven't moved at all. And at $10 million, we've had an average of a 9 basis point lift. And at $100 million, it's been a 20 basis point lift. So getting pretty close to that 25 basis point increase that the Fed passed through. So this is good news for people who leave balances at their banks. The rates are still low, but at least at the high end of the balance spectrum, we're starting to see banks almost move in lockstep with the rate hikes. We'll have to wait and see if that continues with another hike expected this fourth quarter. Now, comparing just all of the banks to each other, this chart is typical of how we show our benchmarks in NDepth. We show a red line for the median and 2 blue lines, one of which represents the 25th percentile and the other the 75th percentile. And normally people want to see that either their rates or their pricing is tracking between the 25th and 75th percentile, and hopefully on the positive side of that. So for third quarter ECRs, we're still seeing some pretty wide variations between the 25th and 75th percentile, especially at higher balance levels, which indicates that there's still probably a lot of room for negotiation. There isn't market consistency yet. So especially if you're leaving some relatively high balances, you probably still have room to negotiate some better rates. This is an interesting chart. This is comparing ECRs from the big 4 banks the largest 4 commercial banks in the United States, against the regional banks, which is everybody else. And last quarter, these 2 lines crossed each other, down somewhere in between 1 million and 10 million. So you had part of the spectrum where regional banks were higher than the big 4 and part of the spectrum where that was reversed. Well, this quarter we're seeing that the regional banks are slightly higher than the big 4 across the full balance spectrum. It's not a lot. It ranges from about 9 to about 13 basis points, but nonetheless it shows that they are moving, I think, to be a little bit more competitive, a little bit more trying to attract additional balances. But from my point of view, the big story still remains with the comparison of ECR rates with money funds. The green line, so the red and blue lines on this chart are exactly the same as they were on the previous chart, the big 4 against the regionals. But the green line at the top is institutional prime money market funds. And you see that that is running about 180 basis points. So there is still quite a large difference between anything, even at the highest end of the spectrum, that you can get on your ECR and what you would be receiving if your funds were invested in a prime money market fund. At the $10 million balance level, you could get, excuse me, somewhere around 50 basis points from either a big 4 or a regional bank, plus or minus a few. Were you to invest that at a prime money fund, of course, it'd be 1.8%, a difference of about 130 basis points. At the $100 million level, that difference narrows a little bit to 100 basis points, improvement from the money funds over the banks, regardless of what kind of bank. Basically, this still represents quite a bit of money. If you're talking, you know, $10 million of balances, if you can get an extra 130 basis points on that over the course of a year, that's $130,000. That's some real change, almost no matter how big your company is. I mean, if you could imagine having an extra $130,000 in your Treasury Department budget to spend for the year, that might go a far way towards some of those projects that have been getting put off because you've had to fight for budget dollars for them. There's some real possibilities here. Not to say that just running out and getting all your money invested is necessarily that easy of a thing to do. I mean, you do need operating balances. You'll never be able to draw down your bank balances to zero in most cases, but and it may take a little bit of forecasting to make sure you're not going to overdraft. But it is time to start thinking about cranking up that short-term investment program if you haven't already done so. Many of the companies we talk to in our consulting work say they have started to put their short investment programs back in place. They've brushed off the investment policies. They've decided which instruments and vendors they're going to work with. They've looked at alternative bank products, so they're making good choices about what to invest in. And they're setting some kind of balance targets that they believe will keep their balances at the right level without pushing them too low, and will let them get as much value out of them as possible. But then we see an awful lot of companies through their monthly in-depth reports, and I can tell you there is still a lot of money hanging around in bank deposits that looks like it could probably go into investments. So if this is something your company hasn't taken a look at yet, I urge you to do that, just because there's gold in them thar hills, as they used to say. Okay, let's move on to our next topic. Oh, I didn't know I had that slide in there, and I didn't mean to leave it in there, but that's everything I just told you. Okay, so we could skip that one. Let's move on to our next topic, which is the dashboard reports, the concept of the dashboard reports. Last time when we got together, we discussed the concept of product families and how integral that is to using in-depth. Now we're going to talk about dashboards. And I will say that We have gotten feedback from many of our users that they like these dashboard reports because they can show them to their senior management. I don't think they're talking about like the chairman of the company or anything, but the senior people in Treasury appear to like these dashboard level reports. And that makes sense to us. Our guess is that they probably aren't particularly interested in the details of service charges, like what goes into your product families or your variance reports. They just want to know that you are looking at that as part of your bank fee management every month. But these dashboards seem to speak to them. And I thought I'd spend a little bit of time talking about what we think people may be thinking about when they say, I like these reports. What am I looking at when I say I like these reports? So on this very first report, on the top of the report in the relationship profile, first of all, if I put myself in the shoes of a more senior Treasury person, the first thing I'm saying is, 22 million in balances. How can I put that to better use? So immediately the wheels start turning. Can we get some of these balances drawn down and invested? Are there other ways to deploy them? How can that benefit us? And I think that is one of the things that goes through people's heads. We have this new column called interest earned, which I am going to talk about a little bit later as one of the improvements that we've made in the last couple of months. But if you're using hybrid accounts at your banks, this is one way to get more interest than just your ECR, is these hybrid interest paying DDA accounts. We now have the capacity to show that on the in-depth report. So that would show up there. That would be something of interest to your Treasury directors. Your calculated ECR, they're going to look at that in this particular case, 59 basis points. Wow, very low. Probably not as low as I expected it might be, but still very low. Again, reinforcing the notion, maybe I can find someplace else to deploy some of this balance money that we're keeping in these banks. Total services, this is sort of a reality check number. About 100,000 a month, so about 1.2 million a year. That's a good rule, sort of rule of thumb number to carry around in your head. People could ask you at any given moment, how much do we spend on bank services? Well, how big is our budget for bank services? Whatever. You're going to be well positioned to be able to say, it's about 1.2 million. And finally, looking at the total excess or deficit position, if I'm looking at that number, a negative 87,000 against my total services of 97,000, I'm saying, wow, we're a long way from being able to pay for all our services with balances. So if that's not our goal, which for most companies it's not, some companies it certainly is, but they're in the minority. If that's not our goal, again, maybe I should be looking at ways to get those balances redeployed. Now down into this section of the dashboard report called wallet distribution. I'll ask you generically, when you set yourself up on in-depth, did you put in your credit bank numbers? There was an opportunity for you, for all the banks that you set up, to enter the percent of your credit relationship that those banks represented. And if you did put any figures in there, that's what generates the blue bars in this report, which is intended to, in a minute I'll explain it in more detail, but basically it's intended to show the percent of your credit, service, and balances that are going to each of your banks that are reporting through in-depth, that you're reporting through in-depth. Now you may not have been attuned to this when you set up in-depth the first time, and it's very easy to go back into the portal and either change those numbers if your credit distributions have changed, or put them in for the first time if you didn't put them in when you were setting yourselves up. And if you have them or you can approximate them, I really encourage you to do that, because I think this report is very interesting to most firms. The point of this wallet share distribution is that whether or not your company is interested in how you distribute these things, I can tell you for sure your banks are interested in it. Banks really want to know that they are getting what they would refer to as their fair share of your wallet. They would really like to know, if they're your lead credit bank, that they're getting a lead share of your cash management business. on reverse, they'd like to know that banks that are very low in your credit allocation, or banks that maybe even aren't providing you credit, aren't getting as much as they are as the lead credit banks. They view the amount of credit that they extend to you as an extension of their balance sheet. They have limited balance sheet to use, and if they're going to use it with your company, they want to know that they're going to get something reciprocal for it. So that's this idea of fair share. And it's not an exact science, believe me, in any respect, but this example that we have here, our demo corp that I'm showing you, illustrates how things can get really turned around in a backwards kind of way. The first two banks, 24/7 and First Digital, very low on all three counts. But then we want to compare Mustang Bank and Tri-Central. So Mustang Bank is a 10% of your credit allocation, but they're getting 42% of your services and a quarter of your collected balances. Contrast that with Tri-Central, who's providing 40% of your credit commitment and only getting 16% of your services. This is the sort of thing that, you know, the bank would say, hey, as your 40% provider, I'd like to look for opportunities to increase my share of your credit, of your services spend. How can we do that? Nobody expects changes to be made overnight. This isn't just flip the switch and business flows from one place to another. But it is the sort of thing that if you've got a misallocation like this, and if that's important to your organization, you want to keep an eye on that over time. And as there are new pieces of business to allocate, or pieces of business that need to move for some reason or another, or a new acquisition that comes in and we're going to have to move some business to one of our existing banks, you'd want to keep an eye on reestablishing something closer to the balance you really want to have amongst your credit banks. This is also the kind of question that you might want to discuss with your boss. If you look at your wallet distribution and you see things being very far off, I mean, it's perfectly legitimate to use that as the opener of a conversation to find out what the company thinks about that, what their goal is in spreading out their their services wallet, and how you in your job can be helping to support that. I think that's especially if you're more of a beginning Treasury manager or new to this part of Treasury, that's a good way to learn something more about what matters to your firm. Okay, the next slide deals with something kind of complicated to explain, and even though it's part of the dashboard, it's complicated. This slide deals with the service that you're charged for called the balance assessment fee. This is the fee that the banks are passing on to you to recoup some of the charges they have, regulatorily speaking, for having balances on their balance sheet and for providing FDIC insurance. It is not strictly an FDIC charge. It's less specific than that, but those are generally speaking the things that the balance assessment fee, or BAF, are assessed for. They're based on your ledger balances. So the higher your ledger is, the higher your balance assessment fee is going to be. You can actually, even though it comes through as a fee on your analysis every month, you can actually impact it by the level of balances you keep and the amount of float in the account. So if you're going to move balances out and send them to a short-term investment account, as opposed to leaving them in your bank, you're going to see your balance assessment fee go down on that basis. And if you do something or other that causes your ledger balances to decline, you're going to see your balance assessment fee lower. I think there's a couple things to pay attention to here. First of all, in the far right corner, the total, the third number down, $3,962, that's how much this company is getting assessed this month. Recall that their total spend is about $100,000. So it isn't a huge number for them, maybe 4%. Still bears watching, but the bigger that number is as a part of your total spend, the more you need to pay attention to it. Second thing to clue into, the bottom line, net effective rate. It is logically sensible to net the balance assessment rate against your ECR so that you see the overall effective rate that you are earning on your balances at each bank. And as you can see, once you do that, it can range from a really depressing and discouraging number like -2 basis points to something that's not too upsetting at all, like the one in the middle, 72 basis points. It's going to be different depending on, again, your level of balances, the level of ledger. Okay, so it's good to keep an eye on, and you can expect that it may move around month to month. Finally, let's move into the time series reports. Senior people, for some reason, like to see things in time series. I mean, I think I'm a visual person. I like to see them in time series. What you need to be thinking about as the person who may share these with more senior people in your treasury is, can I explain the ups and downs that they're inevitably going to ask me about? So for example, on my total service charges, the highest spend bank is Mustang Bank, the red line. And I'm looking at that, you know, the line doesn't appear to be moving around a lot, but if you look at the legend, it's gone as low as $30,000 a month, and now it's above $40,000 a month. Why is that? The answer is probably very logical. The point is, you as the person who is looking at these reports and analyzing your bank fees, you need to be asking that question too and finding out the answer so that when it's asked of you, boom, you have the answer right away. Same thing with Western First Bank, the green line. It's gone from 20,000 to 30,000 down to 20,000 again, and now it's rising back up. Why is that? What kind of business do you do at Western First that causes a spend trend like that? So know those answers. The next time series report is your balances. Balances are going to move with your business cycle. They're going to move with the type of transactions you do at a given bank. If you have a dispersing bank, your balances may be far more consistent than if it's a collection bank. And collections are a little bit cyclical by month of the quarter or by season. Your balances are going to move depending on how much you're trying to manage them to get money into investments or to fund other needs. Again, the point is, how do you explain these movements, and are these all logical? You may encounter on any given month a movement that doesn't make sense, in which case the whole point of doing balance bank account analysis is to find those weird things and be able to dig into them and explain them to make sure nothing is a kilter. And then the final dashboard we have is your calculated ECR. And obviously you want to see this moving up and to the right. You don't want to see it dropping. It's interesting for this particular company, the sort of mustard orange colored line on the top, the very highest ECR, is the bank where this company has the lowest balances. And the second highest, the second lowest level of balances is the blue line, 24/7. So they've got a pretty paltry rate, while this other bank has a pretty high rate, and yet at that other bank, I hardly have any money. So I don't know if that might indicate that there are some opportunities to move balances, or, as I suggested earlier, maybe get them out and put them in a money fund. Okay, that's it for dashboards. The point about the dashboards is be able to explain the variances on them and use them as a tool for yourself to dig into and find out what's going on in your cash flows, in your service usage. Okay, moving on to then our cost-saving idea for this particular webinar, consolidating volume. We have lots of ideas for saving money. I mean, NDepth is full of ideas. People who are using NDepth are full of ideas for how they're saving money. I ran into somebody at a conference about a month ago who told me she had saved $1.5 million a year from using NDepth when she found a price that was substantially out of line relative to her marketplace. Now, she may have been exaggerating a little bit, but even if it was $1 million, it sounds like a pretty good savings. So lots of savings ideas in here. This one we're talking about today is a little bit off the beaten track, consolidating volume. Why would we think that consolidating volume might be a savings for us? Well, there's two reasons. One is that if you have volume, and we're talking about the same kind of business, let's say you have dispersing business spread out at a half a dozen different banks. there's something called the fixed cost effect. Many banks have a lot of fixed costs in their price structure. So whether you do 100 items a month or 10,000 items a month, you're still going to get that $200 a month fixed charge for the service. Then there's going to be a $100 a month fixed charge for the transmission and a $150 fixed charge for being a data capture client, et cetera, et cetera. So those fixed charges are levied small volume, high volume. If you've got lots of pockets of little volume and you're paying fixed charges at all of those places, one of your opportunities is to consolidate and get rid of some of those fixed charges. The second reason consolidating volume can save money is because of the scale pricing effect. As we have done our benchmarks, which you're all familiar with, the pricing benchmarks for the products, we've mathematically analyzed those benchmarks and can demonstrate that for every doubling of volume along the price curve, there is a 25% drop in price. Oh, sorry, 24% drop in price. I rounded it because that's easier for me to remember. But basically, those price curves, as you've seen, slope downward to the left. So the more volume you have, the lower the price is. And that pricing, as you double volume, you decrease price by 25%. That's the other reason you may save money by consolidating volume. So let me go through an example of this. This example is, again, from our demo company, and they're a lockbox user. They have lockbox at 3 different banks. And here in the turquoise circles are their volumes for this month. They go from 5,000 to 3,000 to 1,000 at 3 different banks. And in the pink circles are their pricing. $1.25, $1.18, $1.55. So they're all relatively in the same ballpark on pricing. Just let's check, first of all, against the price benchmarks. Are they priced well? And this is the lockbox benchmark curves. Yeah, their pricing is not bad at all. They're below the median in all cases, and in 2 cases, they're below the 25th percentile. So their pricing is pretty good. But still, let's check this idea out of whether they would save from consolidating. Now, we know at the one bank, Western First, the volume is very low, 800, almost 1,000 items. So the first consolidation idea could be, let's just close the lockbox at that one bank and fold it into one of the others. So how would I kind of model that if I was trying to evaluate the value of this? Well, I'm going to save all the money that I've crossed out with that red X. I'm going to save all of that if I close the Western First lockbox. And then if I move this 864 items into First Digital, what I'm going to incur is 864 times each of the items I've circled in pink. Okay, and that may not be precisely right, but those are the variable costs. So let's assume that they apply to every one of my items that I'm moving. I am not going to pay the items at First Digital. I'm not going to have any increase in the fixed charges, in the transmission base, the deposit prep, the lockbox maintenance. And we're assuming here that we won't have to open new lockboxes, that these items can be just folded into one of the existing boxes. So I can do the math and figure out 864 times every one of these variable charges, how much I'm going to be paying an additional at First Digital, and compare that against how much I'm saving at Western First. Similarly, I could say, let's go all the way and consolidate everything into a single bank. And the easiest way to do that would be to close the lockbox at Western First and First Digital and put that all into 24/7 bank. And I go through the same exercise. I would be moving my 864 items and my 2,864 items into 24/7 and picking up only their variable charges. Okay, get the idea. So if we do that, I did the math of these. And by the way, I'm not counting the effect of different ECRs, which is really precise. If we only moved that little bitty lockbox into First Digital, it's going to save us a whopping $5,000 a year. And if I figure maybe I can get a little bit of a price reduction because I'm consolidating, that might be another, what did I say, $5,000 a year? Or did I say some other number? 5,000, just as I said the right number. Okay. I might be able to get a little price concession, so maybe 10%. That'd be another 5,000. If I moved everything into Bank 24/7, I would save $11,000 a year on my price. And if I was actually able to negotiate that 25% reduction for doubling my volume, because that's exactly what I would have done, I would have doubled my volume at 24/7, that would be worth $32,000 a year. So now maybe it's a bit better. Maybe I'm up possibly around $40,000, $45,000 of savings. Now, lots of you might say, is that savings worth the amount of effort it's going to take me to get all those customers to move? I'm not really sure. It's a lot of work to do that. So this is one thing that you have to actually look at in consolidation, is how hard is it to do the consolidation? Lockbox is probably the hardest product to consolidate, because you have to get every individual customer that's paying you to change their remit to address. I've helped companies go through this lockbox change process, and it takes a couple of months. It takes a lot of effort. It's not hard, but it takes repeated contact and time. So let no one say that that's a walk in the park. Disbursement accounts and wire transfer business, very easy to change relative to lockbox. So it depends on what you're consolidating, how easy or hard it is to get those savings. You might also have issues with your credit allocation, as we talked earlier. If you're moving all of this business into First Digital Bank, well, maybe First Digital Bank isn't a bank that is one of your big credit providers, and maybe you're not really trying to put more business with them. That's something to be thought through. On the other side of making life simpler and easier, it is a lot easier to have one lockbox bank than it is to have three. Much simpler on the service business. Every time something goes wrong, there's only one throat to choke, as they say. One customer service department that your people need to deal with. One place to hunt down if there's an item missing or some kind of error happening. Only one transmission to maintain every month. And you know those transmissions go out of whack every now and then. And you're going to be a more important customer with that customer service group and with that bank for lockbox. You may be able to get better services for the same price. They may have some more sophisticated services, etc. So got to factor that in. And your cash forecasting could be much simpler if all of your inflows are coming into a single bank. Maybe much easier to figure out how much money you have to push into a short-term investment that way, rather than trying to figure out it's in 3 different places, I have to concentrate it, and then I have to move it to the investment bank, or I'm going to move it from 3 different places. This is so much easier. So there's a lot of reasons that it could be better on those counts. The drivers of whether consolidating your volume is going to turn out to be a good idea for you. How much do you have in fixed monthly costs? You know, what preponderance of fixed costs versus variable costs are there at the banks you're looking at? How much volume do you have available to consolidate? And how much pricing difference is there in your variable costs from bank to bank? And then your qualitative considerations kick in. So there's another possibility for ways that you can use NDepth as a way to evaluate cost savings ideas. Okay. Turning to our 4th subject, a tour of NDepth Pro. Pro is the version of NDepth for companies with a complex banking structure and global bank relationships and a need for more, what's the word I'm looking for? More granular reporting than seeing everything at the summary level. And I'd like to, you know, we've talked about Pro. We've been talking about Pro for practically since NDepth was introduced. And I'd like to take you on a very quick tour of what the features are of Pro that differentiate it from NDepth Edge, just because I suspect some of you have come on board as users early in NDepth's evolution, And some of these Pro features may be things that really make sense for you. So let's start out with a couple of the modules that Pro has that Edge doesn't. One of those is what we call account groups, or you might think of it as account hierarchies. This feature, this module, lets you group your accounts into whatever kind of subgroups you want, and then do your reporting at those subgroup levels as well as at an overall summary level. So if you need to bill individual groups in the company separately, if you want to pass through those charges separately and you want to review them separately every month, account groups might be useful. If you want to review spend and balances, etc., by business unit or by different regions of the globe or by different legal entities, a lot of companies have for-profit and not-for-profit entities, and they keep their banking separate. Insurance companies have all sorts of different entities, and they may want to see this information separated at a legal entity level. Account groupings is the module that supports that. It is super easy to set up. It's basically, once you've uploaded one set of detailed analyses, so analyses at the account level, all those accounts will appear in a drop-down window, and setting up your groups is as simple as naming the groups that you want to have and dragging and dropping the relevant accounts into the right groups. That's all you have to do. And then if you need to change it, you know, it's simple as going back and changing some of those things. So it's very, very easy to use. Another module is the contract pricing module. So many people have talked to us about that. When we first started selling NDepth, a lot of people, after they understood what we were doing, the next thing they'd ask was, can it check my contract pricing? So many users want to do that every month, and the contract pricing module does that. It basically compares every line item on which you have a contract price to what you were charged this month and shows you any variances. It has to be able to, and it does, handle all sorts of different pricing, because you could get a contract price that's just a per unit contract price. It could be a fixed price. It could be a volume price. So, you know, if your volume is 1,000, the price is 15 cents. If your volume goes up to 1,100, the price is now 14 cents. Has to be able to accommodate that. Has to be able to accommodate minimum charges. And the contract pricing module does all those things. So this is your tool if you want to check your contract pricing every month. Custom product families module lets you do exactly what it says, define your own product families. We have 10 standard product families in NDepth, and that meets the needs of, I'm going to say about 96, 97% of the marketplace, but there is a small group of you who really need the ability to name and define your own product families. This is also very easy to set up. You literally define the name that you want for your own product family, and drag and drop the line items that you want to have reflected in that product family into the custom family. This is, I think, going to be useful for the cases I can imagine are when people have very different kinds of lockboxes. If all you have is one and it's special, that's probably okay, because you know lockbox is your special kind of lockbox. But if you're a healthcare company and you operate a retail lockbox and a standard healthcare lockbox, you might want to see those separated, because they probably have way different pricing and way different volume characteristics, and managing them together doesn't make a lot of sense. Some of the rest of you might be using sort of sophisticated services like consolidated receivables or consolidated payables, and that might bring together line items that would be, let's say, for payables or disbursements. It might be wires, it might be ACHs, it might be paper disbursements, all coming into one product family. You might need to drag some items like that would otherwise show up in separate product families into your consolidated custom product family. So there's that one. Then these aren't modules, but these are characteristics of Pro. Pro is delivered, all of our reports are created in Tableau. Many of you are familiar with Tableau. Your companies use Tableau outside of Treasury, so you know about it. all of our reports are created in Tableau. If you're using Pro, you automatically have an interactive version of Tableau. And what does this do for you? Instead of getting your reports only in a PDF, you can go into our portal and pull up reports at any time you want to, just on demand, because it's interactive. You can also, which is a big advantage for a lot of people, you can filter what's in those reports. You can choose to see certain reports with just one bank, or pick 2 banks that you want to compare to each one. You can set different months for comparison. You can set different date ranges, like if you wanted to do your variance report against, always using January as your baseline, and each month compare back to January, you could do that. If you wanted to see some of your product family distribution reports, but have them exclude the balance assessment fee, for example, you could exclude certain fields. You could set your variance comparison tolerances, et cetera, et cetera, et cetera. Lots of options for filtering and delineating the data in Tableau. And you can easily download data into Excel. A number of people have mentioned special comparative reports that they would like to see, or trend lines that they would like to create on just certain pieces of data. This capability of being able to download into Excel gives you access to be able to do that each month. And finally, the last feature of Pro that I want to mention is that it accepts information from global banks, the TWIST BSB file formats, as well as EDI and PDF formats. And it does currency conversions if those are required/desired. So this, if you have global bank relationships, whether it's JP Morgan in Singapore and the US, or Australian, whatever, I'm trying to think of that big bank in Australia. So if it's US banks that have global subsidiaries or truly global banks, you can see them all in one place in your in-depth reports and present a whole picture of your entire banking portfolio. All right, and last but not least, I want to get into some updates on in-depth that will be of interest to a lot of you. So recent developments. We've created one new report that is automatically coming to everybody that makes all-in price comparisons easier. Somebody said to us one day, well, this report would make so much more sense if it was sorted this way versus this way. And we looked at it and we went, holy cow, that's absolutely right. We're going to redo that report. So I've got a sample of that to show you. It's in your packets now. Just give me a second and we'll get to the sample. We're now reporting interest earned for the hybrid accounts that many of you are using at your banks. I mentioned that earlier when we were looking at one of the dashboard reports. There were just zeros in the column of interest earned, but that's where it would show up. If you are using hybrid accounts and getting hard dollar interest paid to you, we're reporting that as well. Another development is that anybody who's a beta customer and still has time on their beta, if you are someone who looks at Pro and says, I'd really like to avail myself of some of those Pro features, but I'm still on this beta product, we want you to know we will give you a credit for your beta product if you want to trade up to Pro. So Edge is a $5,000 per year subscription. We will give you a credit for that to trade up to Pro if you fall into that category. So we want to make going to Pro easy and sensible for people for whom it's needed. And finally, the last development is in our pricing on being able to buy a certain module, but I'm an Edge user and I don't want to trade all the way up to Pro. There's kind of a big price difference between Edge and Pro, and many people in particular have wanted that contract pricing module, but they haven't wanted to go all the way to the extra cost of buying Pro. So we've changed our pricing structure, so now you can buy that extra module and still not have to leave your Edge subscription. So if anybody's interested in any of those things, be sure to get in touch with us and we'll talk about what we can do with that. Here I've got samples of those, the new report. Here's that all-in price report. This makes it so much easier to just compare across the line and see how your banks stack up against each other, which is what you really want to do with all-in unit price anyway. After we've gone to the trouble of calculating it for you, you want to be able to see it bank to bank to bank. So it's easy as pie now to just look across the line and see on my account services, I go from 50 to 79 to 45, 22, 59. That's easy. We used to have it arranged in a much less logical way. So sorry for that. Glad we've got that changed. And then the next new, this is the report I showed you previously, the dashboard where we're showing the interest earned. So that's on your hybrid accounts. Some items that we have underway that we want you to know about. Several of you had mentioned, you know, when somebody comes on NDepth, we customarily let them upload starting back at the beginning of that year so that they'll have a good year's worth of history. But some people have mentioned wanting to put several years of history into NDepth. And we haven't really addressed that but prior to this time, but now we're thinking, what are our options for taking in a lot of historic data, and what mechanism do we want to have for people to be able to access that? So we're working through that, and those of you who are interested in that, just kind of keep watching and listening, and we'll get to an answer pretty soon. And if you're one of those people and you're really interested in that, feel free to drop us an email and tell us what your itch is, and we'll see if we can factor in how to scratch that in what we're doing. Another thing we're working on is planning for Edge to eventually be delivered in that interactive Tableau format so that Edge users don't have to wait for a PDF copy of their reports. I don't know yet when that's going to happen. I'm pretty confident in saying it will happen, but I don't have a time frame for it yet. It's something that is standing in line behind a couple of other things that we have to work on first, but that's out there, and that'll be nice for Edge users. And finally, I want to let you all know, we are planning to accelerate the time frame for delivering your monthly reports. You probably know right now we have two report deadlines, one we call the early bird and one we call the regular cycle. And we're going to move the early bird up 2 weeks. So you'll be, those of you who can get your reports in early can get them 2 weeks earlier. And we're going to move the regular report deliverable date up 1 week. We'll be getting more information to you all about that, you know, so you'll have the specifics and you'll have the new cadence calendar at hand, but I just wanted to let you know about it. Some people have mentioned to us that one of the things they do in reviewing their bank account analyses, their banks are going to debit their account for whatever service fees they owe, and they want a chance to check everything, make sure it's right before they approve that debit. So we're trying to accelerate the time frame to better support that activity. Okay, and lastly, I have a great list of articles. If you love to read articles about account analysis, if they don't put you to sleep at night, we've been just writing up a storm. These are all short little articles, 2 or 3 pages at the most, each one taking a different subject relating to account analysis and managing balances. We have one about bad behavior, what kind of bad behaviors you could be unknowingly engaging in that would cause your bank fees to go up. Lots of good articles. Here's where they are. These are the URLs, and you should also be able to access these off our websites. All right. Last but not least, here's our team. I'm not going to introduce them or tell you what they all do, but we want you to know there's a good team of people behind NDepth working to make this a good product for you every month and a better product over time. So with that, I want to wrap up. We didn't get any questions from anybody. we had a question in advance that was about some comparative features, and I think I may have answered that with talking about the interactive Tableau and the ability to download data into Excel. But the person that asked that, if my answer wasn't right on, just send me an email or give me a call afterwards. Any of you that are going to the AFP, we'd love to see you at our booth, 353. If you want to make an appointment to sit down and talk to us, or if you're interested in upgrading to Pro, or perhaps buying one of those modules and adding it to your Edge subscription, feel free, email, call. We're listing Jill here as the contact person for all of that, and I'd say she's the best point person, but feel free to reach out to me as well. And as I said earlier, we've got 1.2 CTP credits pending for you, and we'll be sending out the forms for that. So that is our user webinar for this sort of quarter, and we hope to have another one in the next sort of quarter. And we're always open to hearing your ideas and selections. We love to engage in discussion with you about how this is working for you, how we can make it work better, how you're finding opportunities to improve your bank services allocation and your spend. So thank you so much for joining us this afternoon, and we really look forward to having some more conversations with you. Have a great afternoon, everyone.